Created with free version for non-commercial use.
Okay, so welcome back to the trading desk. Welcome to video number 3. What we're going to start looking at now is the Forex market overall infrastructure. And within that infrastructure, there's a number of things we're going to look at. So, for example, in video number 2, we started looking at the participants within the Forex markets. And we looked at businesses and corporations. And we also looked at central banks and governments as major participants within the Forex markets. We're actually going to take another step now. And when we look at infrastructure, we're going to be looking in more detail and continuing to build out our knowledge as to how businesses and corporations, central banks and governments, as major players and big participants within the infrastructure, how these participants actually, in detail, start behaving. So we're also going to look at the owners of the infrastructure as well. And specifically what we're going to look at is investment banks and retail banks as the major owners of infrastructure where businesses and corporations transact their business. And there is another participant that we're going to look at, and the participants we're going to look at are really the investment community. So we're going to look at pension funds and hedge funds. And really these guys get grouped together with businesses and corporations, as we're going to see, because these guys are making investment decisions in Forex based on fundamental economic reasons and also for genuine business purposes. So we start to group fundamental participants within the infrastructure together. And the owners of the infrastructure transact their business. We're also going to look at retail brokers as part of the overall infrastructure, and retail brokers basically only transact retail trader business. They do a little bit of institutional business with hedge funds, but it's extremely small. And what actually happens is most of the retail brokers clear a lot of their business through the investment banks and the retail banks. So we'll start to look at inside the infrastructure how retail brokers and retail traders differ from the major players, which are businesses and corporations and pension funds. And then we're also going to look at the participation in the Forex markets in more detail, in much more detail, to further develop our understanding of drivers in the way central banks and governments behave. So let's go over to the computer screen and we'll start to look at the full infrastructure of the Forex markets to get a much better understanding and build out our foundation so we can work towards this systematic process. Okay, so welcome back to the computer screen. What we're going to do now is continue to build out our foundation and understanding of the underpinnings of the Forex market. And we're going to do that by next looking at Forex market infrastructure. And the reason we do this is because what we really need to do is understand the parameters of the industry that we're about to go into. By understanding these parameters, what we're essentially doing is understanding what the limitations are in the Forex market of what we can and cannot do. So the main participants in the Forex market are businesses and corporations and pension funds and hedge funds. Now we call these two entities participants because they're essentially trading and investing foreign exchange for fundamental reasons. The next entities that we're going to look at are investment banks and retail banks, and also retail brokers. Now,
when we look at these guys, the way we have to look at them is that we don't look at them essentially as participants. We look at them as the owners of the infrastructure. So we're looking at businesses, corporations, pension funds, and hedge funds as the main participants in the Forex markets. And we're looking at investment banks and retail banks, and also retail brokers as the owners of the infrastructure. So when these guys wanted to actually transact, where do they have to go? They have to go to investment banks and retail banks, and also potentially retail brokers. Now, retail traders as individuals, we've grouped together within retail brokers, but you need to look at retail traders individuals. So as in you guys yourselves, you need to look at retail traders as participants in a similar way to businesses and corporations, pension funds, and hedge funds. So we have our two groups here, the main participants and the owners of the infrastructure here. And we also have central banks and governments. And central banks are not essentially defined as participants. They're not also essentially defined as the owners of the infrastructure. The way we define central banks and governments are entities that get involved in the Forex markets for reactionary purposes and mostly for political and stabilization purposes. And when we look at them in that way, we know they're different from the participants here because they're not actually getting involved in the foreign exchange markets for fundamental or business purposes. They're getting involved in the foreign exchange markets for political or economic/stabilization purposes. So the way central banks and governments behave is very different to the way businesses, corporations, pension funds, and hedge funds behave. So, yeah, we can mark them down loosely, central banks and governments, as extra participants or participants per se in the Forex markets. But we want to distinguish between central banks, governments, businesses, corporations, pension funds, and hedge funds. We need to make a distinction because they do behave very differently and their agenda is different. And we also have the owners of the infrastructure, investment banks, retail banks, and retail brokers. And the participation factor of retail traders is extremely different to both our first set of participants, businesses and corporations, pension funds and hedge funds, and central banks and governments. And once we start understanding how all the different participants behave, and also how the owners of the infrastructure behave, once we start to understand that stuff, what we're essentially understanding when we put them all together is understanding the entire infrastructure of the international foreign exchange markets.
Okay, so let's begin with trying to understand some basic dynamics of the Forex market. The international Forex market is a very heavily traded market. And in terms of dollar value per day, we're looking at about an average of $5 trillion of transactions made in the Forex markets per day, which is obviously a hell of a lot. The market opens in New Zealand at 5 p.m. EST, so Eastern Standard Time in the United States, on Sunday afternoon, and closes at 5 p.m. EST on Friday afternoon. And London really is the capital of the Forex markets because of its time zone. The Forex market on London time is open from 10 p.m. Sunday night till 10 p.m. Friday night. So basically, if you're in London, it's possible to trade the Forex markets during Asian, European, and United States hours. And as a retail trader, you're going to hear a lot of marketing and advertising from Forex brokers, basically telling you that the Forex market never closes, that it's the most liquid market in the world, and the opportunities to make money in the Forex market with very little risk is basically limitless. Well, it's obviously not true. It's basically no more than a sales pitch, and it's not accurate in the slightest. So more on this later as we go through the Forex market infrastructure when we get to retail brokers. But when we break down the volumes, only 20% of volume, so about $1 trillion per day, and I say only, still obviously a lot of volume transacted, but $1 trillion out of the $5 trillion per day in the Forex markets, it's estimated is for real economic reasons or business reasons. And this is against a backdrop of around 80% of Forex transactions, so around $4 trillion a day globally, which is based purely on speculation. And this breaks down mostly into hedge funds and investment bank prop trading desks, but also retail traders. And what we're going to realize as we go through infrastructure, that the speculation of retail traders is actually extremely different to the way speculation is defined within hedge funds and investment banks. And it's a fact that basically 90% of retail traders lose money when they're trading Forex. And a lot of it is down to not understanding the infrastructure, and also because they're uneducated on this and they don't know how to make money from the Forex markets.
So let's look at our first set of participants. Let's look at businesses and corporations, and essentially they break down into two entities: exporters and importers. And we've got a few case studies here to help you understand how this all works. The first one is with exporters. So let's look at a case study of a Japanese-based technology company called Sapporo Semiconductor. So Sapporo, in this case study, are supplying SD-RAM chips to PC manufacturers in the United States. And they're selling these chips priced in US dollars. So 100% of their sales are received in US dollars. And at the beginning of the year, Sapporo are concerned that in the next financial year, the US dollar might fall and the Japanese yen rise against the US dollar. And that would be a change in the exchange rate of $1 buys 120 yen to $1 buying 100 yen. And we've got an Excel spreadsheet in the download section of the video. And if you open the file Corporate Sales Margin Forex Calculator, you're going to find these numbers here. So what this case study actually looks like. So why don't we open this up and just go through the cells? And it's pretty easy to follow. So basically we're in period 1, and next period, period 2, we have a forecast of Sapporo of 130 million US dollars. And the forecast, is in period 2, so here. And Sapporo think that there's a risk that the dollar-yen exchange rate may fall to 100 from 120. Now, the sales in yen in period 1 equates to $130 million times 120. So that's 15.6 billion Japanese yen. The costs of Sapporo are denominated in Japanese yen. Therefore, if we minus our costs from our revenue in yen, we end up with a gross margin in the business of 56%. Now, if the dollar does fall against the yen, we still make, as Sapporo, we still make $130 million in revenue. But when we translate this back to yen, the sales decrease from 15.6 billion to 13 billion yen. And our costs have stayed the same as well. Our new margin is 3 billion yen and is 30%. The difference in the margin is down to the change in the exchange rate. So the difference in sales and change in margin due to the exchange rate. So sales in yen change, therefore the margin changes. This means the margin has decreased by 46% because of the change in the exchange rate. So the local currency loss in Japanese yen, if we're looking now forward at period 2 and predicting what may occur, the local currency loss now is going to be 2.6 billion yen, so around 21.6 million US dollars. So Sapporo look at this and think we must hedge this situation, because if the dollar yen rate does fall from 120 to 100, in local currency terms, this is how much it's going to cost us. And if Sapporo is a publicly traded company, investors, when the dollar starts falling, are going to sell the stock of Sapporo because they're predicting in the future that if the dollar yen exchange rate does fall from 120 to 100, Sapporo's margin is going to get severely hurt. So let's go back to the presentation. So what Sapporo do about something like this, what a corporate would do, is hedge the exposure by entering a 1-year forward contract. And they can do this through a corporate margin Forex account, typically at an investment bank. So let's say the corporate margin account is a 10% margin account, and they want to sell 110 million US dollars. Well, they're only going to put up 10% of that in order to sell the 110 million US dollars and buy 13.2 billion Japanese yen around the current spot rate. So the current rate is $1 buys 120 yen. And if dollar yen goes to 100 by the end of the financial year, they'll have locked in a profit of $22,000. This basically wipes out the local currency loss and the impact that the exchange rate has had on their reported sales and their margin. So by hedging forward, what they've done is taken away the impact of the currency move. They've eliminated it. So let's go back to the spreadsheet. Let's have a look at how this works here. So they put up $11 million margin. They sell 110 million US dollars at the exchange rate of 120, therefore buying 13.2 billion Japanese yen. When they take the trade off, at an exchange rate of 100. Therefore, they're receiving $132 million, locking in a profit of $22 million, which at the original exchange rate of 120 saves them their equivalent loss in predicted sales and margin. So just go through that spreadsheet in your own time. It's pretty straightforward. You can go through the cells, look over the cells, and understand how the calculations work. But essentially, that's a classic situation for exporters. Okay, so that covers exporters. Make sure you go through the spreadsheet and go over the cells and understand how this works. Do that in your own time. Now let's move on to importers. So imagine a situation where you're now an importer in the United States. And here the example is with a company called Megacom, who is a PC manufacturer in the US, and they import SDRAM chips from Japan. And they're also worried about the US dollar falling against the yen as well. So these guys are importing the chips from Japan, and they're actually paying for the chips 100% denominated in Japanese yen. And they're worried that if the dollar falls against the yen, then they're going to be in a position where they basically get less purchasing power for their imports. So they're going to be in a position where they end up buying less chips or getting less for their money. So if the dollar yen rate falls from 120 to 100, they think that their margin could fall by up to 25%. And we have the numbers here. But if we go over to the spreadsheet and click onto importers, we can go through the case here in the spreadsheet. So in period 1, Megacom's costs are 10 billion yen. And in period 2, those costs are going to stay the same. In period 1, the exchange rate is 120. Therefore, their costs in local terms in the US dollar, when we translate back, is 83.3 million US dollars. Now let's make the assumption that sales across the two periods stay constant. In period 1, sales of $150 million mean that on these business dynamics, the margin of Megacom is 66.6 million US dollars. And when we work that out in percentage terms, that comes to about 45%. Now in period 2, costs stay the same, but let's assume the exchange rate has fallen. So the dollar has weakened against the yen from 120 to 100. So $1 used to buy 120 yen. Now it only buys 100 yen. Their costs in local currency terms, in US dollar terms, have increased to $100 million. Sales have stayed constant in the United States, and this means that their margin has fallen from 66.6 million US dollars to 50 million US dollars. The difference in margin is 16.6 million US dollars. Their new margin in period 2 is 33%. Therefore, from period 1 to period 2, their margin has actually fallen by a total of 25%. So this is Megacom looking forward and thinking, if the exchange rate falls from 120 to 100, this is what it will cost us. It will cost us this amount of money in local terms, and it will hit our margin by this amount. And in period 1, looking forward, we use the period 1 exchange rate because our option to hedge this out requires us to use the assumption of the period 1 exchange rate. So the local currency loss, if it does move, is going to be to the magnitude of 16.6 million US dollars, which right now in period one is equivalent to 2 billion yen. So what has to happen is Megacom, if they really are genuinely worried about this, they have to sell an amount of US dollars and buy Japanese yen, allowing them to hedge this exposure out. Let's go back to the presentation. So to hedge the exposure, the board might propose entering a 1-year forward contract and do it in the same way with an investment bank through a corporate account, a 10% corporate margin Forex account, let's say at Morgan Stanley. And what they're going to have to do is sell 85 million US dollars to buy 10.2 billion Japanese yen, and do this close to the current spot rate at the beginning of the financial year. So the current rate is 120, and if the US dollar goes to 100, what they will have done by doing this transaction is hedge out the entire loss for the year and the entire hit in their margin. So let's go back to the spreadsheet. Let's see how these numbers work. So they put up $8.5 million into their corporate margin Forex account at Morgan Stanley. They sell $85 million and buy 10.2 billion yen at the current spot rate of 120. When they go to unwind this position in period 2, the exchange rate has moved to 100. Therefore, they're taking off the trade at the rate of 100, and they're selling 10.2 billion Japanese yen and buying $100 million. Their profit on this trade is $17 million and equivalent to 2 billion yen. This has therefore hedged out the total hit to their sales, their costs and their margin. So that is a classic example of an importer, especially an importer whose exposure is in overseas currencies, and they are a manufacturer locally. So what Megacom are actually doing here is buying chips in Japan denominated in yen, putting those chips into PCs and selling them to US customers in US dollars. That's a very classic example. Okay, so make sure in your own time you go through the exporter and importer examples, especially on the spreadsheet. It's very important to understand how these things work, especially with corporations, because they are big players in the Forex market. And what we want to be doing is trying to predict what these guys will do in the future. So we want to move away always from just looking at the chart of a Forex pair and buying and selling Forex on a whim or because a line has moved on a chart. We want to be looking at a Forex pair and understanding what's really going on behind it with the fundamentals and trying to predict the future. And businesses like Sapporo and Megacom can be really affected by exchange rate movements. And exporters, for example, like Sapporo, can very quickly overnight become globally uncompetitive. And they may even have to cut prices. And that means, by definition, that they're experiencing deflation. Or Megacom, for example, might not be able to pass on their higher input prices to end customers. So they experience the inflation, but their customers don't. But if they are able to pass on the higher input prices, then the customer experiences inflation as well. So the weaker currency for Megacom can cause inflation. When you look at international companies overall, when they have different divisions and different offices or manufacturing facilities, for example, around the world, there's a natural situation where they always have to pay for things in local currency. Staff and wages is a classic example as well. So paying, if you're a US company, paying your staff in Europe, you're going to have to pay them in euros. So every month you're going to have to be buying euros to do that. And if, for example, you think the euro is going to go higher against the US dollar, you'd be better off to buy all your euros up front at the beginning of the year. So in effect, what you're doing is by doing that is you're hedging out all of your FX exposure for your salaries for the next year. The surprising situation is that corporations, there's no rule or regulation that says corporations have to hedge their currency exposure. And frequently what you'll see, and delegates or subscribers to the PTM video series will know that this quite frequently affects the stock market. This is one of the ways that the Forex market and the stock market is inherently linked. So the value of corporations and the value of exchange rates. The way businesses and corporations are active in the Forex markets is they do it through their treasury departments. And if, for example, a corporation really does rely heavily in terms of their business, relies heavily on sales or input prices that are inherently connected to exchange rates, especially companies with very thin or low margins, if they're in that business and they don't understand the risks and how to hedge them, they can get into trouble very quickly. So what you'll find is that in the Forex markets, corporations are extremely active because they absolutely have to be. If you're doing the professional Forex trading masterclass and your objective is to work as a professional trader, maybe even in Forex, if that is your objective, a good place to get work experience on this note is actually in a corporate treasury department, because you'll be exposed to Forex situations every day. So working for an international corporation that has to hedge its exposures overnight for the next month and even forward for an entire year, it's a very good way of getting into the industry through the back door. What you can also do is with the spreadsheet is download the spreadsheet, go through the export and import impacts that Forex can have. And what you can do is just play with the numbers. You can change the numbers, see what happens if corporations are exposed with very low margins. You can see that corporations have a lot of exposure and can change very, very quickly in terms of their margins and profit. And this is actually the reason why they have to hedge currency going forward. Now, what you need to think of is we've looked at the kind of money flow behind exporters and importers and how these guys are exposed and how quickly this exposure can impact them. Now, I want you to think about this in terms of a country level. So if a country is a net exporter or net importer of goods and services, so exactly what we looked at before, is the country itself running a current account balance surplus or deficit? Well, it works in exactly the same way. The exchange rate impact for a corporation is exactly, in debit and credit terms, the same situation for a country. So if you're smart about it, what you can do is actually go into the spreadsheet and start looking at country level numbers. And the numbers will get quite big. They can go into the trillions, but the principles stay exactly the same. A net exporter will have negative shocks when the exchange rate goes higher, and a net importer will get negative shocks when the exchange rate goes lower. So just remember these principles, go through the spreadsheet, make sure you understand how the numbers work, and start thinking about this at country levels, so aggregate levels, and try to think of how the debit and credit system works, not just for a corporation, but for a country with big numbers. So whether a country is a net exporter or a net importer, and how big moves in the exchange rate can have an impact on them. Overall, we're looking at businesses and corporations specifically as participants in the foreign exchange markets. And as we look at businesses and corporations, we know that exporters and importers will be affected by the exchange rate moving up or down. And if they predict that something is going to happen in the future, you're going to see this starting to occur in the exchange rate of a country, because many businesses that are in the same position will actually start to hedge their currency exposure. And when you see moves in exchange rates, you'll now understand what is actually behind them, the real moves. Okay, so let's finish up with businesses and corporations. Do take your own time to go through everything. And let's move on to pension funds and hedge funds as major participants in the Forex markets. So pension funds and hedge funds are very active in the Forex markets on a day-to-day basis as well. That's because they're investing and trading internationally. And for them to, for example, invest in a stock or a bond in another country, so a country different to the one that they're domiciled in, the pension fund or hedge fund has to first purchase the currency of the country that they're buying the stock or bond in, because the stock and the bond will be denominated in the local currency terms. So very similar to the import example that we gave earlier within businesses and corporations. The import example of buying chips in Japanese yen, then putting those chips into computers and selling them in US dollars. Very similar to that situation. Hedge funds and pension funds, when they buy stock or bonds abroad, they will buy them in local currency. And then when they sell them, they have to convert back. So the exchange rate matters over the lifetime of the investment. So for example, if a pension fund sells dollars to buy yen, so they are looking to buy Japanese equities, if they buy the Japanese stock market and they make a 20% return on the Japanese equities, when they come to sell them and convert back into US dollars, if the rate, the dollar yen rate, is 20% higher, they're not going to make anything. So the currency conversion on the way back out of the trade has cancelled out the profit on the whole trade. However, the currency exposure can be hedged out, similar to corporations, prior to making any investment abroad. And the currency, if they want to hedge it out, they just have to do exactly the same thing as the corporations did, which is buy dollar yen at the value it is when they put the position on in the first place, so at the time of purchase. And in a case where the fund is denominated in yen, this wouldn't really matter because they wouldn't have to convert back into US dollars. But if their fund is denominated in US dollars, this is obviously going to have an impact on them. And if they're investing internationally and trading internationally almost every day, obviously the returns of a fund can be seriously affected by exchange rates. So because of these relationships, there's a very inherent correlation between a country's currency, the stock market and the bond market at any given time. And this level of correlation doesn't change very often, and it changes or tends to change over long periods of time. Hedge funds themselves often trade actually the correlation between asset classes and try to use liquid strategies like in futures markets where they can put big size on and take big size off very quickly to hedge the risk in their portfolios. So a classic risk-on strategy in which global gross domestic product is forecasted to go higher usually means that the world outside of the United States is set to grow faster than the United States, because obviously the United States is a very mature economy as the world's leading economy. And a classic risk-on strategy in this scenario would be to sell US dollars and buy rest of world currencies, rest of world stock markets, and debt. A classic risk-off strategy would be the reverse. So if global GDP is forecast to go lower, that usually means that the world outside of the US is set to grow at a slower pace than the US. So in this scenario, we would be looking to potentially buy US dollars and sell rest of world currencies, rest of world stock markets and debt. And this risk-on, risk-off situation happens quite a lot in the market. And you'll see this happen over larger timeframes, over 1 month, 3 months, 1 year timeframes. It's pretty common. The risk-off basket can actually be a hedge to the risk-on basket in times of uncertainty. So, for example, if there is uncertainty over a weekend or uncertainty over a 1, 2 week, 4 week period, hedge funds or pension funds that hold risk-on baskets across their entire funds might actually go into the market into liquid assets like futures and put on a big hedge on their portfolio for the duration of what they consider to be a small amount of time. So liquidity in the US dollar majors that we looked at earlier and global index futures, so on stock markets, means that hedge funds and pension funds can be in and out of the market very, very quickly with billions of dollars of exposure, and they can take it off very quickly as well. So it's really important to understand how these guys operate, because when there's big moves in exchange rates, especially between major trading partners, so for example, the US, Japan, Europe, when there's major moves, they can almost become self-fulfilling because these guys have to hedge their returns in their portfolio if exchange rate moves are against them and very quick. So again, not just looking at a currency on a chart and buying and selling it on a whim. We want to be completely moving away from that. We want to understand what is going on behind the exchange rate and how these participants are likely to behave in the future. And that way, once we understand that properly and have a real appreciation for it, we can understand or begin to predict what these people might do in the future, and also the kind of stress levels between major exchange rates. So when an exchange rate goes very high, what level of that exchange rate becomes kind of a stress level for businesses and corporations and a stress level for pension funds and hedge funds. And of course, currency trades performed by hedge funds, that in particular, they don't need to necessarily be for hedging purposes. What you'll find is that global macro funds will actually have speculative positions, long or short currencies, quite frequently, because it's literally part of their strategy. And it can be in the form of spot cash positions, leverage synthetic plays through contracts for difference, or in the big liquid markets in futures, and even potentially in very illiquid options. The point is that as it's part of their strategy. Speculation is absolutely part of their strategy, but they have at their disposal all of these assets in which they can use the assets as potential hedges to their funds. So classic funds would be looking at hedging their funds globally with risk-off situations at any one time, in case those risks occur. So understanding the businesses and corporations and the pension funds and hedge funds, it's obviously pretty important to really understand what's going on behind the currency moves. We're going to look later more into the global macro strategy when we go further into the systematic process of idea generation. And it's going to become important then, having this knowledge, acquiring this knowledge, so we understand how to predict these things. And predicting future moves is what currency trading is really all about. So looking at the participants, understanding what the participants do and how they participate fundamentally in the currency markets, understanding what they do, taking that understanding and using the information to predict what they will do in the future. So not just looking at a currency chart and buying or selling an exchange rate on a whim, really understanding the fundamentals of what happens behind the currency moves. And global macro funds, they will have at any one time, of course, what we call speculative position or speculative positions. But these positions are predicated on their views of fundamental drivers. And the fundamental drivers come from their understanding and forecasts of what the major participants will be doing in the future. And when we go through our systematic process later, this is what we're going to be looking at. We're going to be taking exactly the same approach that global macro funds take in order to end up with positions in currency pairs. So we'll come on to that much later and go much more in depth into the fundamental drivers that global macro funds use in order to predict the future and take currency positions. But for now, let's move on to our next section of Forex market infrastructure. And let's start to look at what we term the owners of the infrastructure, the intermediaries, investment banks and retail banks. So investment banks and retail banks, they're really the infrastructure that we have to deal with in order to transact in the foreign exchange markets. And that's really for businesses and corporations and pension funds and hedge funds, but there are other players as well. We'll come on to retail traders a little bit later. But first of all, with investment banks deal exclusively in the Forex markets with large corporations, pension funds, hedge funds, but also deal with governments, family offices, ultra high net worth and high net worth individuals. Whereas retail banks, on the other hand, are dealing with small and medium-sized enterprises, so SMEs and retail clients, hence the name retail banks. But whether it's an investment bank or a retail bank, it doesn't really matter the name that we give them. The only difference really is the size of the client and the sophistication of the client, so the size and complexity of the trades. So investment banks, for example, will give corporate clients, pension funds, hedge funds, sophisticated hedging facilities. So in Forex, what we looked at earlier, for example, forwards and also futures and options. Retail banks are more plain vanilla. They offer the services of more plain vanilla spot transactions for SME, so small and medium-sized enterprises. For example, like the businesses and corporations we looked at earlier, so small and medium-sized businesses and corporations, so importers and exporters, for example, that do repeat business and require Forex to pay for foreign inputs, goods, services, and foreign currency purchases. For example, outside of businesses, retail banks will cover retail clients, so the man on the street. So if you're traveling somewhere on holiday, you'll need to buy foreign currency before you go. And how you transact, or how participants transact with the infrastructure by buying and selling Forex through them, how they transact can be quite different. So, for example, for retail banks, unless you're a very regular client or big client of the retail bank, a spread or price that you pay on a liquid dollar cross or cross rate can vary massively. So if you've ever been to the counter of a retail bank and bought euros or bought dollars, you'll find that the processing fee is staggeringly large. The way they do business, retail business, is also done very risk-free. So it's all done on what's termed as an agency basis. So basically they'll take the market rate, which can be very, very small in terms of spread, and add on a really large commission either side of the trade. So you'll buy foreign currency at a very high rate and sell foreign currency to convert back into your domestic currency at a very low rate, and the spread can often be anything between 1% and 5%, even more for exotic currencies. That's just for the liquid ones. At investment banks, client business is done on both an agency basis and on a risk basis. And often the bank will actually take the opposite trade to the one that the client is taking in order to provide them liquidity. Then they will go in the market and trade out of that risk. That's the investment bank taking a risk position. With an investment bank, the spread on a Forex pair when dealing as a client, in most cases, will simply be the prevailing market rate. So definitely with the liquid dollar crosses and cross rates, the spread will be as little as 1 pip. And that's a measurement we use in the Forex market. We're going to come to this later when we look more at basic calculations. But with investment banks, there's very little or no commission on the trade. So the infrastructure here is very apparent. The bigger and more sophisticated you are, and the more often you trade, the less you will pay to trade in Forex. And also, what's necessary to understand from this particular section covering investment banks and retail banks is that the business that goes through investment banks and retail banks is typically from the participants that we've looked at. Therefore, this is real, fundamental business. It's fundamentally driven. The business is being carried out for genuine economic and business purposes. So if you remember right at the beginning of this video, we outlined the split between speculation and fundamental volume that is transacted in the Forex markets on any given day. And speculative was 80%, and real economic and business transactions is in the minority at 20%. It's important to understand that the owners of the infrastructure, the investment banks and retail banks, because we have to deal through them, all the fundamental business is done, or the vast majority of fundamental business is done through investment banks and retail banks. And this differs greatly to retail brokers and retail individuals who transact in the currency markets purely for the purposes of speculation. The speculation we talk about, retail traders are essentially buying and selling currency pairs, typically for absolutely no economic or business reason. And what retail traders believe they are doing is predicting the future of where the currency may go to. But the reality is quite different. Now, the objective right at the beginning that we outlined is to provide retail Forex traders with the systematic approach to predicting future currency moves in the same way that professional traders and hedge fund managers do. So retail Forex traders can implement the same approach. But the approach that is used by professional traders and hedge fund managers is actually totally different and actually opposite to what retail Forex traders do. And we need to understand how the retail brokerage market in Forex works in order to understand the parameters of this industry, because the fundamental business that gets transacted in the Forex market, what really matters to the Forex market, is done through investment banks and retail banks, and the most speculative transaction volume in the Forex market is always done through retail brokers. Now, we did mention earlier that global macro and hedge funds are speculative, but this is different because the drivers that those guys are using are drivers based on fundamentals. The drivers used by retail traders are not typically fundamental drivers. Typically what you see with retail traders is they will buy and sell charts. So on technical analysis alone, they will make a decision to buy or sell exchange rates. But they may also be reactionary to economic numbers. What do we mean by reactionary? Well, seeing an economic number coming out, like the US jobs number, and reacting to it by buying or selling the exchange rate as to the direction on whether the number was considered to be a good or a bad number. Well, those two things are not actually doing it fundamentally and correctly, because if you just look at a chart, you don't understand the fundamentals behind the chart itself. So you're actually just buying and selling a chart on a whim or on a pattern of past price movements. So you're not predicting the future. And also, if you're buying and selling currency pairs solely based on technicals and an economic number that's come out, the economic number combined with the technicals is also backwards looking. Typically what you will find is that most numbers that Forex retail traders trade on are backwards looking numbers. They're telling you what happened in the past. And professional traders and hedge fund managers actually take the opposite approach. They're looking at drivers, fundamental drivers, to predict what businesses and corporations and pension funds and hedge funds, governments and central banks will be doing in the future. So 1, 3, and 12 months into the future. So it's important to understand the retail brokerage environment, because it's almost important to do that to understand how not to do it. We're going to go through this now, and the vast majority of retail traders don't really understand how this all works. And this is one of the main reasons why the vast majority of them lose money. Okay, so let's have a look at the retail broker infrastructure and understand how all this works. The first thing we have to understand and we have to identify really is the problem. Well, the problem is that based on all statistics out there, this is a very, very well-known and well-talked about stat. This is called the 90-90-90 phenomenon, which is so prevalent in the retail brokerage industry. And this stands for 90% of retail traders lose 90% of their money within 90 days. And that's across all asset classes. But in Forex, it's actually even a little bit higher. And it's because retail Forex traders take a completely different approach to professional traders and hedge fund managers. On the left-hand side, we've got the typical professional trader or hedge fund manager approach to international Forex markets. And on the right-hand side, we've got the typical retail trader approach. And this can be broken down into specific situations. And there's some good examples here under each section as to how these two participants of the markets differ. So the approach of the professional trader understands all of this stuff and has been schooled in it. And their approach is basically a long-short portfolio approach with a 1 to 3 month time horizon. However, the popularized media perception of what an investment bank professional trader or a hedge fund trader manager does differs from the reality. So everybody thinks that investment bank professional traders and hedge fund managers are trading in and out very quickly all day long and have lots of terminals and do hundreds of trades per day. Well, actually they don't. They do the opposite. And the perception also is that one of the main drivers of their decision-making process is to always look at charts. That's not the case either. The approach is long-short portfolio management with a 1 to 3 month time horizon, and the majority of their decision-making drivers come from fundamentals. And that's around 80% fundamental and 20% technical. This is the approach we're going to be using later when we go through the systematic process of attempting to predict future currency moves and build out that systematic process in the same way that professional traders do. On the other hand, the approach of retail traders are always under the impression that trading is about short time frames. So confusing market making with long-short portfolio management. So the media perception that traders are always trading in and out and they're standing on trading floors at investment banks or at hedge funds with lots of screens and always shouting, that just doesn't exist. It doesn't exist anymore, because in the old days, that popularized perception of what that is was actually market making. So that was traders dealing on the phone and dealing through the computers on behalf of clients. That was not them trading with their own money or trading with the bank's money or, in fact, trading with investors' money at the hedge fund. That was them market making, so dealing directly with clients. So retail traders mix these things up, and they think that professional traders trade in and out all the time, and they confuse what used to be market making with what professional traders actually do when they're trading as a fiduciary manager of capital. So trading with long-short portfolio management in mind and taking the 1 to 3 month approach. So the opposite is actually true to what retail traders think goes on. So retail traders, because they think this is the approach that they take. They try to go into Forex markets and buy and sell things all day long, trying to make small amounts of money. Whereas the actual real professional trading approach is buying and selling currencies over much larger timeframes and having a long-short approach and portfolio management, so having multiple positions. And this brings us on to the next stage, which is diversity and risk management. Prop traders at investment banks, the guys that use the bank's money to try and make money in the financial markets, and also hedge fund managers, they typically have multiple positions at any one time. And typically you'll see them having 20 to 30 positions, which are both long and short across multiple asset classes. So they're not likely to just have one currency pair in their portfolio and they just sit there and watch it all day and go home flat at the end of the day. They actually manage their risk in a totally different way. So they'll be diverse, 20 to 30 positions, and they'll be long short. So there will be correlation in the portfolio at any one time, and that correlation will change over time. So 20 to 30 positions, having 3 to 4% position sizes in the portfolio. And they will actually have a cap in their portfolio of the volatility that they're allowed to have in the portfolio. So they'll have, for example, a 12% cap in terms of volatility on their portfolio. So they're allowed to have up to 12% volatility in their portfolio on an annualized basis. And they'll target a higher return than the 12% cap. So perhaps 18%, which will be very ambitious, but the point is simple. The return targeted is higher than the percentage volatility cap. And I just want you to imagine for the moment that, you're somebody who has made a lot of money in their life. And, let's say, for example, you started a company when you were very young and you built that company up over a number of years, let's say 30 years, and you sold the company and you end up selling this company for, say, $200 million. And I want you to imagine yourself now sitting retired in the south of France, and you're interviewing people in order to assess these people, assess them in terms of their money management, because you want to give them your money to invest or trade. And I want you to imagine that you're sitting in a cafe in the south of France, and hedge fund manager number one turns up and he shows you how he trades. And this is how he takes his trades. He creates portfolios where he's got 20 to 30 positions, long and short. So 20 to 30 positions, long, short, and everything is 3 to 4% position size in the portfolio. He's got a volatility cap of 12% and targets 18%. And his track record is he's been around for 7 years and he's made money 5 years out of 7 years. Then I want you to imagine number two turning up for the interview. And number two is what we see on the right-hand side. He's got concentrated risk. And his account has typically 3 positions at any one time. So, for example, long cable, long sterling US dollar exchange rate, short the Dow Jones Industrial Average, and at any one time, this manager tends to just have a favorite position in the cheapest stock that they think is the cheapest at the time. Which one do you give your money to? Well, it's pretty obvious. You're going to give your money to the first guy because you've worked hard your entire life and you don't want to give your money to someone irresponsible because they're probably going to lose it. So if you think about it in these terms, this is why hedge funds stay in business, because they actually fulfill a mandate. So they go to their clients and say, I'm going to take 12% risk and target 18% return. Is that the amount of risk and return that you want to take? Yes. And I'm going to be diverse as well. Okay. So we're going to spread the risks. We're going to be diverse in our approach. And it doesn't matter if they beat the market over a 1 year period, because the market volatility may have been higher than the volatility of their own portfolio cap. So the investor signs up in the first place knowing that, which means if the hedge fund achieves their mandate, they're going to stay in business. So you'll see that, in popularized media, nobody can really understand why hedge funds that underperform the market always seem somehow to stay in business. Well, this is the reason why. The market return just doesn't matter. On the right-hand side, what you've got is the concentrated risk, no track record, and the retail trader thinking that this is the approach that professional traders take, when in fact they take the approach on the left-hand side to risk, and the right-hand side is what retail do, and the two are literally polar opposite. In terms of return, the professional trader, hedge fund manager, they're literally employed to trade from now until they retire or the day that they die. They're hired on the mandate that we've talked about. Market outperformance is irrelevant, contrary to the mainstream media. But the approach of the retail trader is always short-term binary. So this is what we were talking about earlier with technicals and economic numbers. So always trying to make big money from an individual catalyst. So for example, the US jobs data, non-farm payrolls that comes out every month, retail is basically reactionary to stuff like this. What professional traders do is they try to predict months before what is going to happen. And then when it actually happens and is backwards looking, they use the liquidity of the retail market to actually get out of the trade. So they predict what's going to happen in the future, and retail traders react. Now, if you take the approach on the left-hand side, the professional trader approach, and you apply this across all asset classes, so currencies, commodities, equities, bonds, if you take the approach on the left-hand side, you are literally employed. It's your job to preserve capital and get growth from that capital over time. If you take the approach on the right-hand side, which is the typical retail trader approach, well, we know what the result is. The result is the 90-90-90. 90% of retail traders lose 90% of their money within 90 days. It's pure capital destruction. So on the left-hand side, it's all about capital preservation and growth. On the right-hand side, the result is simply capital destruction. So understanding how the retail trader market, in terms of brokers and the infrastructure, is really important, because as a retail trader, you're part of this infrastructure. You're interacting with it on a daily basis. Every time you access your trading platform, you're interacting with this infrastructure. So we've got to understand how this really works so we can operate within these parameters and limitations and operate successfully. So the differences really between the professional trader or hedge fund manager and the retail trader, the first thing really is in expectations. The professional trader, hedge fund manager, has realistic expectations and targets, and they aim to get rich slowly. And these expectations and targets are generally always met. And they're in business to set realistic expectations and targets, and they generally meet them. They tend to want to or aim to trade forever or until retirement. The problem with the retail trader is that they always have, whether they've been set by themselves or influenced by outside influences, so brokers themselves, or maybe even educators that have incentives that aren't aligned with the incentives of the retail trader. They tend to have unrealistically high expectations and targets, and a get poor or stay poor mentality. So the kind of lottery mentality. Buy the ticket to the lottery and there's a small chance you'll win. And these expectations and targets are generally never met. And the vast majority of retail traders, as we've seen, just blow up or go round in circles every year, never making any money. Now, what I want you to think about now is how this infrastructure really works behind the scenes. As I said, understanding this infrastructure is really key to understanding the limitations of what you as a retail trader can and cannot do when you interact with this infrastructure all the time. Let's think of this from the broker's perspective. If you're a brokerage company, you have, let's say, thousands of clients. If the majority of your clients make money, then it means that your clients never, ever blow up and they never close their trading accounts. So think of this from the investment bank perspective. So investment banks like Goldman Sachs, Morgan Stanley, Bank of America, Merrill Lynch. Why are these guys still around? Why have they been in business for hundreds of years? Well, it's because they always benefit from their clients making money. So don't listen to the popularized media that investment banks try to lose their clients' money. They don't. They literally do the opposite. One of the first things you'll be taught when you go to work for an investment bank, the first thing you'll be taught is that making your clients money is the most important thing, because we always want them to be around as the investment bank, so they always pay. Retail brokerage businesses are totally different because the vast majority of clients blow up, and retail brokers only benefit short term, not long term. So they get paid commission and spread, and we're going to look at other ways in which they get paid in the short term. But longer term, it doesn't work very well because they have to replace the clients that are always losing money. So the businesses are very, very different. The institutional side of the market, with hedge funds and pension funds dealing and interacting with the infrastructure of investment banks, is the opposite of the way the retail trading infrastructure works and how retail traders interact with retail brokers. And as we've seen, the majority of retail traders are going to lose all of their deposited margin within 3 months, so within 90 days. And we'll be discussing on the next slide what margin really means and how this really works. But in terms of the broker themselves, just imagine you're a broker with 10,000 clients, and let's say 80 to 95% of them are always down at any one time. Well, that just means as the broker, you can never really grow your business. So let's say you want to go from 10,000 clients up to 15,000 clients by next year and significantly increase the amount of money that you have on account, client accounts. And if the vast majority of your clients always lose money, so every week this amount of money that's on account just keeps going down, how do you grow your business? Well, it's very straightforward. You take a big chunk of the money that they pay you and you go out into the world and you advertise and market like crazy for new clients. And all the new clients coming in, all the new retail traders, basically replace the guys in every period. So every 1 to 3 months, replace the guys that have blown up. So then if 30% of clients close their accounts every month, then new people open their accounts every month. And it's just a merry-go-round. And this is obviously completely opposite to the way investment banks, in terms of infrastructure, deal with pension funds and hedge funds. So if you want to be one of these people, one of these retail traders that opens their trading accounts with a couple of $1,000, leverages like crazy and trades euro dollar every day, or trades a major currency pair like euro dollar and uses backwards looking information and charts to make decisions and loses 90% of their money very quickly, then go for it. That's the status quo. There are plenty of retail brokers that will be happy to open your trading account with very little information and let you deposit those few $1,000s within a few hours, and within a matter of days or weeks, it will be gone. But you clearly don't want to be one of these people. So how do we actually avoid it? How do we make sure that we're not one of these people? Well, the first thing to do is completely understand how this business works. And when you interact with the infrastructure on a daily, weekly, monthly basis, because you just have this knowledge in the first place, you'll never allow yourself to fall into these traps. So what is margin? Let's have a look at that first. It's the amount of dollars that you put into your trading account. And the amount of this amount of dollars is used as collateral, and it enables you to borrow when you're trading on, for example, CFD or spread betting, so contract for difference or spread betting. These are typical instruments in the United Kingdom, Europe, Asia. CFDs are not available in the United States and Canada. They were banned there in 2010 for very good reason. The reason being is that clients were using them in the US and Canada, using these instruments to over leverage and take far too much risk. And the US and Canadian regulators shut down CFD trading in 2010. That should be sending a very strong message to UK, European and Asian retail traders that you can very easily over leverage using these products and blow up very, very quickly. Well, in the US and Canada now, you have to put up a lot more money into your trading accounts to enable you to trade using leverage. This is something we can look at a bit later. But let's have a look at these derivative instruments on CFD. When you're trading on leverage, whether it's CFD, spread betting, or even in the US, Canada, when you're dealing on the broker's platform, in the vast majority of cases, you don't own the underlying asset. What you own is a derivative of that asset. It's a piece of paper that says the price of the contract will mirror one for one the price of the underlying asset. And then when you're trading on the broker's platform, you're not buying and selling the underlying asset. You're buying and selling the contract. Now, initial margin, that's what you put on deposit in your trading account at the beginning. Your variable margin is what's used as the collateral on the positions that you've got open at the moment. So let's say, for example, you put $20,000 into your trading account, you took a bunch of positions, and then you were down $1,000. Well, basically your variable margin is the $1,000, and the broker takes that out of your account at the end of every day, and you're left with, in this case, $19,000. And in the opposite situation, if you actually make money, the broker will pay the difference into your trading account. And this is why contracts for difference are called contracts for difference in the first place, because the price that you buy the contract at or short the contract at, dependent on where the value of the contract is now, which mirrors the value of the underlying asset, so it changes as the underlying asset changes. Where the value of the contract is at any one time, the broker, whether you're in profit or in loss, will either add money to your trading account if you're in profit, or take money from your trading account if you're at a loss. And this is the same in spread betting in the UK, Europe, and Asia. In America and Canada, it really depends on the brokerage platform that you're using. You definitely won't be able to use CFDs or spread bet, but it depends on the broker you go to and what you're trading, as to whether you're trading a over-the-counter, so an OTC derivative contract of the underlying asset, or you're actually trading the physical cash spot market, which is the underlying asset itself. It depends really on the broker you're going to and what instruments you're trading as to how much leverage you will get. So speak to your broker about that. It can vary quite widely. But let's have a look at Forex. Forex in Europe and Asia is typically a 1% margin requirement. In the US, if you get access to Forex futures via your broker, you may be able to trade on 10% margin requirement, but typically it will be about 20-30% until you've built up a profitable track record. Then the broker will allow you to lend or borrow more money. But let's use the 1% example because it is a slightly extreme case, but it's actually very, very typical in Europe and Asia. Margin requirements basically means how much the broker requires you to put in your account to enable you to take certain size positions in Forex. So in this example, we're taking a $100,000 position, and this is a typical size position, as you'll see later when we move to the calculations on Forex. But if you have a 1% margin requirement and you take a $100,000 position, it means that the broker only requires you to put $1,000 in your trading account to enable you to take that position. And this basically means that if you lose 1%, you're going to lose the $1,000. So if your initial margin was $1,000, it means you're 100 times leveraged. So if you lose the 1%, you're going to be wiped out. Now, what if, for example, your initial margin, you decided not to put up $1,000, you decided to put up $10,000, and you take the $100,000 position. So your 1% becomes your variable margin, and your 10% is your initial margin. And what you're actually doing is you're utilizing only $1,000 of your $10,000 if the Forex pair moves 1%. And we call this utilized margin. So the other $9,000 is just sitting on account as collateral in case anything bad happens. So if you start to lose 3%, 4%, you basically don't receive a phone call or email from the broker asking you to deposit more money. That call is termed in the industry as a margin call. So on this $100,000, what happens is if you do lose 1% on the $100,000 position, the exposure that you have is $100,000, you will be down 10% on your initial margin because you've lost $1,000 of the $10,000. Now, this happens a lot in the retail trader Forex market, i.e. guys putting $1,000 into their account in Europe and Asia. You'll need more in the United States to take that $100,000 position, but it's typical in that if the position moves 1% against them, they'll be almost wiped out and they'll have to put more money in their trading account to pay for the losses. But the broker on their side has actually transacted a $100,000 position. Now, wouldn't it be amazing if we had tens of thousands of clients who were all doing this and we could somehow take the other side of these trades? Because 90% of the losers, 90% of the people, who are doing this are losers, and they lose 90% of their money within 90 days. So if we took the other side of these 90% of losers, we ourselves would have a 90% win ratio. We would win on 9 out of 10 trades. Wouldn't that be amazing? We'd make a lot of dollars. So by taking the other side of all these trades, it's obviously a very profitable situation. Well, there is a way of taking the other side. you basically become the broker, because the vast majority of retail brokers, certainly in Europe, UK, and Asia, will take the other side of the vast majority of the trades that go through their trading platform, and they will run the position until the trade is exited. Why? Because they know that 90% of their clients lose money. In the US and Canada, the numbers are a bit lower, but it's around 75% at any one time. And the broker usually hedges their positions, but taking the other side does still occur in the United States and Canada. So it's something that everybody as a retail trader globally has to watch out for. You have to understand how this business works and position yourself so you don't become one of these fools that falls for everything that the broker wants you to do. And the reason why they want you to do these things is because they have inherent conflicts of interest in their business model to the interests and incentives of what you want to be doing, which is using your own money to make money consistently from the financial markets. They want you to speculate. And it's not just brokers, it's also educators. Educators make their money in the same way that brokers do, because they have contracts with the brokers that give them a percentage commission based on the volume and size that you trade. This is something that's out of the remit of the course, but I'd urge you to attend one of our free seminars where we'll basically go through all of this with you. If you haven't been already, then book yourself in, but we can go through some of the main situations here that occur in the Forex market with brokers. So brokers do this directly. The broker's revenue is made up of 4 variables. So we have the OTC gain, the spread, the commission, and the financing turn. In the Forex market, really we can put spread and commission together because most brokers, the commission is the spread. So in Forex, we have the OTC gain, the spread, and the financing turn. Now the spread or commission revenues, it's the same thing. You're just paying the broker to trade on their platform every time you trade. The spread or the commission revenues are pretty well publicized, but very few people understand the existence of the other 2 main variables, which is the over-the-counter and financing turn revenues. So on a standalone basis, if the only revenue streams were spread or commission, the broker makes more dollars the more clients trade and the bigger size that they trade in. It's pretty straightforward and obvious, but people always forget this. They overlook that the broker's incentive is to make you trade as much as possible, as frequently as possible. They are incentivized by volume and size. They would rather you trade a lot more frequently and in bigger size, so they get paid more. Of course they would. That's how they maximize revenue. But the other 2 variables are not as widely appreciated. The financing term is pretty straightforward. We looked at margin, where you put up your initial margin, which is the amount of money you put in your trading account as collateral against your positions. The money that you borrow is financing. You borrow this money from the broker to trade, and you will pay for borrowing it. Now, what the broker does is they agree a credit line with a bank. So let's say borrowing up to $250 million at 2.5% per annum. Then they offer the credit via the trading platform to retail traders at an annualized rate of, let's say, 3.5%. And what this does is transfer the risk from the broker to the creditor and the retail trader client. So the broker actually becomes the broker of credit, and they take a turn on it. They make a percentage point, or in the business we call it a turn, on the credit. It's the creditor's dollars that are at risk, and the retail trader will get stopped out whenever they lose all of their collateral or all of their initial margin. The financing itself, which this is something will surprise you, is the credit facility is negotiated actually using the retail trader's collateral. So when you, for example, put $20,000 in your trading account, that collateral is there in order as credit financing terms with the creditor via the broker in order for you to borrow money on top of it. So you're putting up the collateral, not the broker. So they don't have any risk in this whole process. Now, the OTC gain example, the credit facility is used by the broker in order to take the other side of your losing trades. And they keep the difference as market making profit. So what you're actually doing is depositing money into your trading account, which is then used as collateral to enable the broker to lend you more money to trade, but they use the credit in order to take the other side of your losing trades. So what you're actually doing is sponsoring the broker to take the other side of your trades. So going back to this idea that we take 90% of the losers, and so we take the losers who are 90% of all retail traders, and we use someone else's money to take the other side of those trades, and even get the person or the people who are providing us with the losing trades to pay for the credit. I mean, it's a dream business. You couldn't make it up. The broker has no risk, and they're just taking the other side of losing trades and charging a turn on the financing to the parties who are providing the losing trades. You've got to understand this infrastructure. The more in detail that you understand it, the more you will realize why retail traders lose money. Once you understand why retail traders lose money, you can avoid all of these mistakes. Understanding how infrastructure works in the Forex market, especially on the retail side, because that's our objective, understanding how Forex market infrastructure really works is absolutely key to whether you're going to be profitable or not long term. And understanding the incentives and the conflicts of interest is really, really important. It can take you as little as 1 day or even less. There's cases out there where it can take you a matter of hours to open a retail brokerage trading account. And what you'll typically be asked for is a proof of ID, so a passport, a proof of address, a utility bill, and you'll be asked to sign off terms and conditions that state you're totally aware that you can lose all of your money. So it's like a disclaimer for losing all of your money before you've even started. Now, what you've got to do is start asking yourself the question, why is the broker, so someone who is a complete stranger to me, allowing me, a complete stranger to them, to borrow up to 100 times the amount of dollars that I put into my trading account to trade the financial markets? Literally, in a typical example, it would only be a day before that they've asked you for a passport, proof of address, and asked you to sign off the terms and conditions. 1 day later, you've deposited a few $1,000s, and now they're willing to lend you up to $200,000 to trade the financial markets. It's pretty obvious why they would want to do that. It's because they have a 90% win ratio. They are looking to take the other side of your trades, and they want to do this in the biggest size possible with no risk. That's the OTC transaction. They're also lending you the $200,000 at an annualized rate, and on a daily rate, divide that by 365, and the money will come out of your trading account every day. And they'll pay their creditor and keep the difference. They want you to trade in the biggest size possible, because if you trade $200,000 in and out every day instead of a few $1,000s, they get paid 100 times more on the spread of the Forex pair. So you can see how all of these conflicts of interest come together. We've got one, the very obvious one, the volume and size incentive, which is the spread. And we've got the not so obvious one, which is the OTC and financing turn gains that they make the bigger and more frequently you trade. So this is how it actually works in practice. Let me show you how it works behind the scenes. On the left-hand side, we've got a situation that we're going to call the A book. And on the right-hand side, we've got a situation that we're going to call the B book. Now, I want you to imagine actually being the broker, and you do have 10,000 clients at any one time. And you walk in every morning to the office at 7 a.m. and you know that today, 90% of your clients, 90% of the trades that go through your trading platform are going to lose money. You've got your credit facility in place, and you can lend up to 100 times what people put in their trading accounts in Forex. What you actually do is you can systematically split up the losers and the winners in terms of trades and in terms of clients. So let's say, for example, 90% of your accounts when you walk in the morning are down. So 9,000 accounts are in the red, and 1,000 accounts, 10%, are in the blue. Well, what you do is you just have a piece of software, an algorithm, that basically you put all of your losing clients into one side and all of your winning clients into one side, and they both get treated differently for that day. So you put all of your losing clients on what is called in the brokerage community the A book, and you put all of your winning clients on the B book inside the same algorithm. Let's have a look at what happens to a losing client first. When a losing client goes on the platform and enters a position, the broker automatically takes the other side using the credit. They run this OTC position naked with no hedge until the losing client unwinds the position. Then the broker automatically unwinds, because when the losing client trades out of the position on the platform, the broker is taking the other side again, which means they're closing their equal and opposite position. And the vast majority lose dollars because they are losing clients, and the broker makes dollars. So the broker on this trade gets paid the OTC gain, the spread or commission, and the financing turn. So very profitable clients for the broker. Thank you very much. What about the clients who make money? Well, they automatically go on what's called the B book. The broker, when they trade on the platform, takes the other side, and outside of the platform, the broker also has access to the real market, and they hedge the position that they've taken against the winning client on their own platform by taking the opposite position, so the same position that the client's got, in the underlying asset, which is trading in the real financial market. So let's say, for example, you purchase euro dollar on the platform of your Forex broker, and you buy a quarter, let's say you buy 200,000 euro dollar, and the broker automatically is filling that position on the platform by taking the opposite side. They've taken the spread on that and sold you euro dollar. They then go into the underlying market and buy 200,000 euro dollar automatically. Then when you come to unwind it, you go to sell it. The broker buys it off you, but then they sell the underlying as well. all at the same time. It's all done automatically through the algorithm. So when you unwind, the broker auto unwinds. The client makes dollars, the broker makes dollars, but they'd make less. So in this instance, they're making the spread or commission, and they're making money on the financing term. In this situation, whether you're a losing client and the broker takes the other side, or you're a winning client and the broker takes the other side but follows the position as well, so they automatically hedge your winning position. Whether you're a losing client or a winning client, it doesn't matter to the broker because they make money with no risk, no matter what happens. This is how the infrastructure works. However, they make less money from winning clients, and they have to take two positions with winning clients. They have to take the opposite position on their platform, and they have to use double the amount of capital they would with a losing client to actually buy or sell the underlying asset to hedge the position that they've taken against your platform trade. So they would rather commit less capital and they would rather make more money. So they would rather you be one of these people. They want you to lose money. They want to maintain the status quo. They want you to be somebody who doesn't know how to trade properly so they can take the other side and you don't become one of these people over here. Because here, they have to use twice the amount of capital and they make less money from you. They make a little bit of money over here, but they make lots of money here. They want lots of losing clients trading on their platform. So it's pretty damn obvious that there's a massive conflict of interest here between what retail traders are trying to achieve and what retail brokers want their business to be every day. And the conflicts of interest, as we've discovered, we've broken them down into volume and size incentive that drives the first conflict of interest. But the second conflict of interest, the second driver, is the incentive to take the other side and earn money on financing charges. Now, what happens is the status quo is maintained because, like we mentioned earlier, brokers spend a lot of money on protecting the status quo. So spending a very high proportion, 30 to 50% of all commission or spread that they receive on marketing and advertising to convince you to do what they want you to do. The conflicts of interest basically lead to a front door at the retail brokerage industry, the front door of lies and BS to retail traders believing that this is the way you trade as a trader in the financial markets. And the lies are very intricate in detail, and they're all basically designed to make you trade in the way that they want you to trade, so they get paid, not you. Usually the BS comes in one of 5 areas, or all 5 areas, or some of these 5 areas. This is what you'll see across the entire retail trader market. So the first one is misleading information. So what they'll show you is strategies that guarantee them, not you, a daily income and calling it trading. So they'll try to convince you that the financial markets are like an ATM and that you can tap the financial markets every day for money. The opposite to that is actually true. So what they'll do is show you strategies that are basically not trading strategies. So for example, showing you how to follow a line on a chart, and that chart will be over small time frames, and teaching you how to click the button on the trading platform. That's not a trading strategy. And treating the markets like an ATM is not a trading strategy either. The second one is false advertising. So making you believe that professional traders approach the markets in the same way that they want you to. The truth of the matter is that no professional trader day trades unless the volatility allows them to do so. This is something we're going to move on to later, the way the professional trader approaches the markets. So in the same way that we looked at briefly earlier with the long-short portfolio management over 1 to 3 month time horizons. Obviously, over longer time horizons, more volatility exists, and traders capture volatility. Their time horizon that they choose is predetermined by what the volatility allows them to do, not the actual name of the time horizon itself. So for people who call themselves day traders, imagine a situation where, like we talked about in the video series earlier, where the asset you're trading just doesn't move in one day. Well, the broker will try to convince you that even if the asset doesn't move in one day, that's what professional traders do. Of course they do. This is what they do every day. They go into this asset and trade it 10 times a day. That's so they get paid. They want you to believe that. But professional traders know better. The next and third area is turnkey free resources. So a brokerage platform these days will probably cost $5 to $10 million to develop and market, because the broker will be competing with other brokers to get your business. However, they give their platforms away for free. Why do we think we give them away for free? Well, it's quite obvious. So they can, when they give it to you, you become used to using it. And if they give it away for free, you're more likely to take it. So when you actually take it and you get used to using it, you'll deposit money and you'll begin trading on the platform. And it's similar to placing a slot machine or fruit machine, as we call it in the UK and Europe, a slot machine in your home and giving you that for free to entice you to use it. And you're basically enticed to put money into the machine and to possibly become addicted. The platform costs $5 to $10 million development and in marketing, and they have to market it every month as well. They do this and give it away for free to entice you. Why would they give it away for free? So they can actually get it into your hands, entice you to use it, put money into the system so they can take the other side. And what they'll do is they'll try and brand the platform as a professional trading platform. The problem is no professional traders use them. So it's a complete lie. The next thing is mis-selling of education. They'll train you basically how to use the trading platform. So if you've ever been to a broker seminar or gone into a broker's office or even gone onto their website and watched videos and downloaded the platform, what you'll see is that they'll teach you how to use the platform and they'll brand it as education. So they're going to teach you how to buy and sell on their platform and call it education. So trying to give you the impression that you're learning how to trade. Well, pushing the buy and sell button is definitely less than 1% of trading. And a monkey can do it. All they're doing is actually teaching you how to pay them. They're not teaching you how to actually decide what to buy and sell and when to do it, and how to build professional portfolios and trade properly in the same way a professional trader does. All they're doing is teaching you how to buy and sell. And that's definitely less than 1% of trading. It's the least important thing you will ever learn. The other thing is rebranding brokers as traders. So what they'll do is give themselves titles which will divert your attention away from the truth. And the truth is that they're incentivized by volume, frequency, and taking the other side. So these titles that they give themselves, a good example might be they'll call themselves a chief market strategist or a chief market technician. Well, it all means the same thing. If they're incentivized by volume, frequency, and taking the other side, so if they take a commission or spread and they take the other side and they charge you for financing, they're basically a broker. And what they'll do is these guys that call themselves chief market strategists or chief market technicians, they'll basically just constantly drip feed you with non-price sensitive information that will actually decrease your chances or odds of making money. And that basically increases their odds of making money. They're basically just puppets that are put out there in the media to convince you to trade constantly, as frequently as possible. And if you've been around the retail trader market for a while, you're probably going to recognize a lot of these things that we've just talked about here. You're going to recognize that this is something you experience almost on a daily, if not weekly basis. So if you basically trade in this way, so in a way in which your interests are aligned in their favor, you're definitely going to end up in the 90-90-90 club, and you're going to lose money. But it's obviously a problem because retail traders are exposed to this necessary evil where retail brokerage platforms are the main source of liquidity that's available for a retail trader. But it simply doesn't mean that you have to access the market using this infrastructure and trade in the way that they want you to trade. You can actually use the infrastructure and trade in a way that's profitable, consistently profitable over time. What you need to actually do, and this is the mode of thinking that you have to get into, is you use the infrastructure to access the market, but you do the opposite of everything that they tell you to do and want you to do. So you're essentially taking a real professional trader approach and massively increasing your chances of making dollars over a consistently long period of time. And if you think about what we've done to this point, we've looked at building out our foundation in the Forex market in terms of understanding how everything works. And we've started looking at the infrastructure as part of that. And what we've looked at is businesses and corporations, hedge funds and pension funds, and then retail. And the way businesses and corporations, hedge funds and pension funds transact is based on real economic situations, real fundamental and business situations, and they do this through investment banks. And in the Forex market, especially in the Forex market, businesses, corporations, hedge funds and pension funds deal on fundamentals. They are using fundamental drivers and looking forward, not backwards, forward, and trying to predict the future. And they take positions in currency pairs as instruments to either hedge themselves or even speculate, definitely in the hedge fund arena, to speculate on future currency moves. And they do this through investment banks. And retail is actually a completely separate entity. Retail is trading through retail brokerage platforms typically, and the two aren't even really connected. They're actually, in terms of infrastructure and approach and risk and return, totally the opposite to each other. What you've got to start thinking is you need to start getting into this mode of thinking that you are the hedge fund. You're running your own hedge fund, and you're looking to take fundamental positions in currency pairs in the same way that professionals do, but doing it in an environment, so in the retail brokerage environment, where there's parameters that are against you. So you have to basically work within the parameters to optimize your outcome. And these brokers, the retail brokers, they don't like clients who make money. You're basically a low value client to them because it means they get paid less spread because you trade less frequently. And they also have to hedge out their exposure every time you trade because it's a higher capital commitment for less return. And they also make less money on financing charges because you're using less leverage. So if you are doing the opposite of what these guys want you to do, what you're doing is trading less frequently, trading with less capital, and you're putting up more margin in your account to cover your exposures. And because you're using less leverage in relation to that exposure, or in relation to your margin, they make less money on the financing charges. You're much lower value to them, but that's what we want. We want to make the money. We don't want them to make the money. And when you compare the retail market to the professional trading side, all professional traders know this. It's some of the first things they learn when they go into the market. They learn to be cynical, and they learn to understand where incentives are and where conflict of interest is. And they avoid conflict of interest. The professional side of the market and the retail side of the market are basically just representations of the two types of money that occur across asset classes, actually. So not just in Forex, but also in the stock market, in commodities market, in the bond market as well, but especially in Forex markets because so much volume trades and retail is so prevalent in the Forex markets. There's two types of money, and the professional side and the retail side represent these two types of money very accurately. There's the smart money, which is the professional traders who know all of this stuff. And there's the dumb money, retail traders, that just believe everything they are told. And they blindly rely on the infrastructure that's provided to them by the retail broker. So they just trust that all the infrastructure that's given to them is somehow there for their benefit. It's not there for the benefit of the retail trader. It's there for the owners of the infrastructure to take money off you. And you're just falling for one of the oldest tricks in the book in the financial markets. Dumb money retail traders are just always led down the path to capital destruction, as we looked at earlier, by the owners of the market infrastructure and even the smart money. The smart money, ironically, require dumb money to exist, because if dumb money didn't exist, smart money would have less opportunities. All that the retail Forex market is these days is a mechanism by which wealth is transferred from the dumb money to the smart money. You've got to get into this mode of thinking and really understand the differences between the professional and the retail side, how the infrastructure is set up between investment banks, businesses, corporations, pension funds and hedge funds dealing with investment banks, and how the infrastructure for retail traders is actually completely outside of that infrastructure. The two are not even connected. And you've got to get rid of everything on the right-hand side here, because everything on the right-hand side is what retail brokers want you to believe is what professional traders do. So you fall into the trap of doing everything on the right-hand side on their platform, and they get paid. If you do everything on the left, first of all, you will be a person that doesn't lose money, which will open the door to you opening the upside in your portfolio or your trading account and giving yourself a real chance of making money. So the first step in capital markets, and this is what any hedge fund manager or professional trader will tell you, the first step is to learn how to not lose money. And learning how not to lose money, the vast majority of it comes from understanding how the Forex market works and how the infrastructure of the Forex market works, so you don't make all the classic mistakes and get wiped out. And what we're going to be doing throughout the whole presentation is we're going to be building this knowledge and foundation that allows you basically to ditch the dumb money approach and embrace the professional trader approach in the Forex markets. So you can basically implement this yourself without any outside help and be consistently profitable forever. If your objective, by the way, whether it's just using your own money or eventually working in the industry at an investment bank, hedge fund, or proprietary trading firm, it doesn't matter what your objective should be. Right now, your objective should just be on how to make money consistently. Build your track record and become a person that operates like a professional trader / hedge fund manager. Eliminate your downside and allow yourself to open up the upside. And as we go through the presentation, we're going to be building all of this out for you. So we're basically going to be ditching the dumb money approach and embracing the smart money approach. So we're going to continue to build out our foundation. So you've basically got to this point where you've seen the participants in the infrastructure of the Forex markets. And we started with businesses and corporations, pension funds and hedge funds, and we've learned that they go through the investment banks. And that's the fundamentally driven approach of real players that make real economic decisions and business decisions when trading Forex. And we've noticed and learned that the retail trader is dealing through the infrastructure of the retail broker, whose infrastructure has an inherent conflict of interest with everything that the retail trader wants to do. The retail trader really just wants to be like the professional trader and consistently make money using their own money over their lifetime. Now we're going to move on to the Forex market infrastructure of central banks and governments. And one of the ways in which central banks can actually get involved in the Forex markets is actually through direct intervention. And that's basically manipulating the exchange rate for the benefit or the general benefit of the economy. So we know that we've got different Forex market regimes. So we have the fixed and the floating regimes. And actually within floating regimes, we saw earlier that we also have dirty or managed floating regimes. And regardless of whether the regime is fixed, floating, or a managed float regime, the central bank basically must accumulate foreign currency reserves because they can't buy a currency like any other participant in the Forex markets. They can't buy a currency without first selling another. So when a domestic currency depreciates and the central bank wants to intervene, they use their foreign currency reserves to buy their own currency. And they can't buy their own currency without selling a foreign currency first. Also, on the flip side, when a domestic currency strengthens and the central bank wants to intervene, they have to sell their own domestic currency in order to buy foreign currency reserves. And those reserves build up, allowing them in the future to basically intervene to buy their own foreign currency. So these things basically swing in roundabouts, and this is how fixed regimes, as we learned earlier, work. They have an upper bound and a lower bound, and if their currency appreciates to an upper bound, they want to sell their domestic currency and they accumulate foreign reserves. And if they go to a lower bound, they basically want to buy their own currency and use the accumulated foreign currency reserves to do so. And a good example of this was actually in 1992 with the ERM, the exchange rate mechanism crisis of the pound. And basically, this was a fixed regime in which speculation got the better of the central bank. So this is just a good example to illustrate how speculation can even occur within fixed regimes. But it's also a good example of how direct intervention occurs. And the Bank of England basically had a fixed band around the Deutschmark, into which they signed up to a strict policy where they basically have to keep the pound within a 2.5% either side of a fixed rate, a 2.5% band either side of a fixed rate. And basically the Bank of England, when the pound went to the lower band of the Deutschmark peg, the market speculated on the amount of foreign currency reserves they had and how it was an untenable position, both economically and politically. So one of the main problems was actually the rate at which they joined up to begin with. So the rate was basically a fudge, a political fudge, and the rate was too high. And every time the pound dropped against the Deutschmark by 2.5%, the Bank of England had to step in and buy the pound at an unsustainably high rate. The ERM was the precursor to the euro. It was the currency regime that was the precursor to the euro. So the idea was that all the original euro members would be part of the exchange rate mechanism, and they would harmonize their currencies and eventually all end up with the same currency. And as we know, the ERM basically broke and the pound was devalued and traded through the lower bound. And that's because the Bank of England ran out of foreign currency reserves and couldn't buy the pound. They couldn't support it. And this has ended up obviously becoming a bit of a blessing in disguise, because the euro so far has been a disaster for many nations that joined, even for the main founding partners, Germany and France. But the ERM goes to highlight exactly what direct intervention is all about. Central banks can intervene in the foreign exchange markets. They can use foreign currency reserves and print money, but enabling them to sell their own currency and accumulate foreign currency reserves if they believe the exchange rate is too high. And in the ERM, basically, people made a lot of money that day. It wasn't actually a day trade. It went on for months, building up into a situation where it became very obvious to the market that the pound was pegged too high to the Deutschmark. It was a political and economic fudge, and speculators built up huge shorts in the pound, and the pound collapsed. Foreign currency reserves ran dry, and the Bank of England couldn't support the pound. They had to let it go down. George Soros himself, the famous hedge fund currency speculator, made over £1 billion in one afternoon. And that was in 1992, when £1 billion was a lot of money. Obviously, it still is. But back then, it was a huge return. And as mentioned, even in this situation, the positioning in the market, which was opposite, taking the opposite trade to the Bank of England, this was building up over many, many months. And the time frame was not one day. It was building up over a long time. So central banks can directly intervene. The classic way they intervene in most floating and or managed floating regimes is actually through classic money supply. So what we have for you in the download section is a full definition in the PDF called Money Supply Definition Example. A full example and definition of what money supply actually is. So it would be good if you went to the download section of this video, downloaded that PDF, and really learnt the definitions of money itself, definitions that are the most common used in modern financial systems. The most common definition of money supply is called M2, and the money multiplier is most commonly calculated as M2 over MO. If you want to go to the download section, download the money supply definition, it might be worth doing that before you continue to go through this part of video number 3, and just learn those definitions. So here we're just going to take for granted that you've been through that already. What you're going to find is that most modern financial systems incorporate what's known as a fractional reserve banking system, which is basically the mechanism by which money is created by central banks. And this flows to the banks and from banks to institutions, corporates, businesses, and individuals. So basically, whenever a bank gives out a loan in a fractional reserve banking system, a new sum of money is just created from basically nothing. And the new type of money is what makes up the non-MO components in the M1 to M3 statistics. And there's basically two types of money in the fractional reserve banking system. There's central bank money, which is basically obligations of a central bank, including currency and central bank depository accounts, but also commercial bank money, so obligations of commercial banks, including checking accounts and savings accounts. Central bank money is defined as MB, and commercial bank money is defined as MO to M3. And basically, in a fractional banking system, there's a reserve requirement ratio, which is a minimum fraction of customer deposits and notes that each commercial bank has to hold as reserves, which they can then lend on. These required reserves are basically normally in the form of cash stored physically in a bank vault, so vault cash, or deposits made up within a central bank. And basically, central banks increase or decrease the money supply, the classic one being M2. So please check the definitions to understand that, by increasing or decreasing the banking reserves. We've also got in the download section a PDF called Fractional Reserve Banking Example. Please go through that as well so you understand exactly how this works. So you've got the understanding of the money supply definition and how a fractional reserve banking system works. If you learn those two PDFs inside out, you'll have a really good understanding and foundation of how money supply in the classic mechanism works. It's really important to understand this from a Forex retail trader's perspective, because this is what underpins all the fundamentals of money. So please go through that and try to understand it fully. And when you spend some time going through those two PDFs, what you're going to realize is that basically adding to reserves is basically what the classic money printing mechanism is. It basically allows banks to multiply their deposits and increase the amount of M2 or money, which is interchangeable definition. So money and M2 is the same thing. It basically allows banks to multiply their deposits and increase the amount of money in circulation in the economy at what is supposed to be a constant and fairly predictable rate. M2 is basically the broadest and most important measure of the money supply. That's why we phrase M2 and money as really the same thing. It's the most important measure of the money supply, and it's basically used as an injection, i.e. increasing reserves, as an injection mechanism to basically increase the money supply by increasing reserves, and a withdrawal mechanism to basically slow down money printing. Basically, when you slow down it, you slow down the amount of reserves or decrease the rate at which reserves are increasing to control inflation. So you have to really think here about how money going into the system and money coming out of the system works. Increases in the rate is an injection, decreases in the rate is a withdrawal. And a country's exchange rate is basically affected by the central bank's policy on the rate of growth of M2. And what you're going to see much later in the video series when we go through the systematic process is that M2 is a big driver to our calculations of whether a currency is experiencing inflationary or deflationary conditions. So if we go back up here to this sentence that we looked at over injections and withdrawals, the central bank policy on how much they're printing and what rate they're printing is basically an indicator of their intention for inflation or deflation. And it's one of our big drivers. So we're going to come back to this later, but for now, just really understand the definition of how this mechanism works and understand the principles of how injections and withdrawals work in the classic money printing mechanism. Now, basically in a dirty or managed float system, so a floating system that's managed by a central bank, the money supply is used as a classic tool to basically manipulate the exchange rate higher or lower if it becomes too extreme for the economy itself. So when we looked at businesses and corporations earlier, this is how it all links together. So we looked at exporters and importers, and we realized that if the exchange rate goes much higher, it can really hurt exporters. And if the exchange rate goes much lower, it can really affect importers. And when we looked at the balance of payments, if a country is a net exporter or net importer, we thought of this on an aggregate level. And at an aggregate level, this is where central banks come in. And for net exporters, a high exchange rate can be very damaging. And for net importers, a low exchange rate can be very damaging to the economy. So this is how central banks intervene. They either intervene directly or indirectly. Direct intervention is going straight into the Forex market and buying and selling currency to manipulate the exchange rate. In an underhand way, so a dirty or managed float, the classic way to affect the exchange rate as a central bank is through increases or decreases in the rate of change of M2 money supply. Central banks can also use other ways. So not direct intervention, not a classic indirect intervention, but also there are various tools at central banks' disposal that they can use in a non-direct intervention as well. One of these, which has made a lot of headlines in the last few years, is through quantitative easing. This is basically a non-classic monetary policy that's used by central banks to stimulate an economy when basically the classic monetary policies like increasing loans through just increasing M2 and interest rates have failed to stimulate the economy. So if a central bank basically begins to realize that the economy is under so much stress that using classic situations like increasing the money supply or decreasing interest rates have failed, they may look to other policy tools to affect the exchange rates. What will happen is a central bank will implement QE by buying a specified amount of financial assets. Sorry for the typo here. That should be off. So buying a specified amount of financial assets. Usually this is bonds, and usually it's government bonds. And this basically raises the price of those bonds, the financial assets, and decreases the yield. We're going to do a lot more work on this later when we go through the systematic process. At this stage, just understand the foundations and principles of how these things work. Basically, this increases the monetary base because when they're buying bonds, it's an injection into the economy, when other injections have maybe failed to work. So it's an expansionary monetary policy designed to stimulate the economy. And even though it's a non-classic intervention, there are kind of classic ways within the non-classic intervention how central banks do this. Usually they will buy short-term government bonds to create a very quick and liquid injection into the economy, and lower short-term interest rates in the process, and that encourages banks to make short-term loans, and this gets money out into the system, or it's supposed to be designed to do that. There are various problems with the mechanism which are probably out of the remit of this course, but you can go away and study how this really works in your own time if you want to. But for the moment, just really understand the basics and principles, how it's supposed to work. However, when short-term interest rates are basically at zero and it hasn't stimulated loans, there might be no other option to increase the monetary base. So QE is basically the final lever that central banks will turn to when interest rates are basically zero, and the classic M2 approach of increasing the money supply can't or fails to stimulate the economy by increasing the monetary base. And when QE basically comes in and is used as a tool, buying the short-term government bonds and lowering interest rates even further may not even work as well. So QE obviously differs from the classic monetary policy of buying, as in making an injection and increasing the monetary base, or selling, decreasing the monetary base with a withdrawal, short-term government bonds, in order to keep interbank interest rates at a specified target value. It differs because it's only one-dimensional. Central banks are not going in and saying, okay, the monetary base, we're looking to increase it, so we'll buy bonds. Or the monetary base, we're looking to decrease it, so we'll sell bonds. It's all one way. A quantitative easing policy is when a central bank makes the public statement that their policy and strategy is to only buy bonds, a one-dimensional approach. So it differs slightly to the classic, well, it differs a lot to the classic monetary base increase approach. So what you'll have heard in the last number of years, obviously very famous cases in the United States with quantitative easing programs, that was obviously combined with very low interest rates that were failing to stimulate the economy, and also classic M2 money supply failing to stimulate the economy as well. And the US Federal Reserve, the central bank, came out and publicly stated that they are instigating a quantitative easing program, therefore communicating to the market that they are a buyer of bonds for the indefinite future. This has also manifested itself into Japan and also manifested itself into Europe, the euro area. And it's become quite a popular policy in recent years because of economies failing to grow and failing to be stimulated by classic approaches of M2 and interest rates after the financial crisis. QE can also be used not just to buy short-term bonds, but also long-term bonds. And this can have the effect of lowering long-term interest rates across the interest rate yield curve. And what can happen is central banks, when signaling to the market that they're a buyer of long-term bonds, this can basically end up flattening out the yield curve and could have unintended consequences, i.e. the original priority was to stimulate the economy with injections via purchases of short-term government bonds, thus increasing the monetary base through short-term reserves and loans in the fractional reserve banking system. But it can end up being the case that central banks can go further out than short-term maturity in the bond market and go to long-term maturity and signal to the market that quantitative easing programs are going to have to be around for a very long time. And what we've seen recently in the United States, Europe, Japan, is purchases of longer term, not just short term maturity government bonds. If you want to go and look further into how the bond market works, for example, when a flattening of a yield curve occurs, if you go online and just do your own research, there's plenty of information out there that will be able to tell you what the consequences of these things are and what it actually means when you have a steepening or a flattening of a government bond yield curve. But basically, it can have unintended consequences because a flattening of a yield curve can mean that an economy is under a lot of stress. The risks to QE in terms of putting this type of policy out there and making it a long-term policy tool, it can actually end up being a lot more effective than intended. So the intention to stimulate is usually in a reaction to lower growth forecasts and deflation. And if you go out there and purchase as the central bank lots and lots of government bonds and make lots of short-term and long-term injections into the monetary base to fight lower growth and deflation, this could actually end up occurring that you overshoot your targets. So you end up creating a lot of inflation in the longer term. Or it's not effective enough if the banks basically do not lend out the money on the additional reserves that they're taking in. So basically, if loans at the banks are at capacity, so there's zero excess reserves, the reserve ratio requirement is at the maximum. And it's at the maximum it can possibly be. And increasing reserves or lowering rates to do so to zero doesn't work, then the implementation of QE can basically be seen as a really desperate measure or a last throw of the dice. What you're basically being told is that no more levers exist, and QE is the last throw of the dice. Implementation of QE is obviously an injection to the money supply, and therefore it has a risk to it that basically the exchange rate goes lower. You're increasing the amount of money in circulation, and the value of your money as a country decreases, and the exchange rate goes lower relative to the rest of the world. But you can also, when the exchange rate goes lower, you can also, what we call in the financial markets, import inflation from abroad through your export market. So long-term domestic inflation can go much higher, and it can have the effect of never even increasing bank loans through increased reserves, and then you import inflation from abroad. What do we mean by that? It means, well, your goods as an exporter become a lot cheaper on the international markets relative to the same good somewhere else. And more money flows in from abroad because your exports are being sold at a more competitive rate. And the money to pay for those exports comes into your economy, flies into your economy. And that inflation can be basically imported into your country, and export prices themselves go up in compensation for the amount that the exchange rate has gone down. That inflation can be imported into your country. So to summarize in this area, what you really need to understand is just at this stage how the basic fundamentals of the classic money supply and non-classic money supply mechanisms work, and also how central banks can use plain vanilla tactics and just directly intervene with the exchange rate. Understanding how this infrastructure works is important, because when we look at fundamentals and we look forward in currency markets, we're trying to predict what the participants are going to be doing in the future. And central banks, more so even these days, central banks are major participants, and we have to understand how they work in order to understand how they may participate in the future in the foreign exchange markets. So it's very important to understand this infrastructure, understand how central banks can actually intervene in the plain vanilla direct intervention route, the classic money supply route, and through some more funkier, outside of the box, non-classic ways. And the one we've looked at here is quantitative easing, because that's the non-classic way that's become so prevalent in the last 5 years. So understand how this works. Make sure you go through those PDFs in more detail and understand why we're looking at this in so much detail at this stage, because it's very important to understand the injection and withdrawal mechanism through the money supply and the fractional reserve banking system, how that actually works, so we can take that knowledge, making our foundation stronger in order to make the systematic process stronger later. Because in the systematic process, we're going to be taking all of this data and using it to predict what central banks and other participants will be looking to do in the future. So we've looked at direct intervention, the classic money supply approach and the non-classic money supply approach of QE. That's going to help us a lot when in our understanding when we go to the systematic process later. What else is going to help us understand and build out our systematic process is how interest rates actually work. Now, when interest rates are being set by central banks, it's very easy to think or envision that a central banker is walking in to the central bank, sitting down at a desk and deciding that the interest rate is going to be at this level, because we see them stand up on many occasions and publicly state, we are raising rates to this level, we are decreasing rates to this level, and the rate is predefined. Well, it's actually not. The way the mechanism works is that interest rates are set through the interbank market. What does that mean? Well, at the end of every day, banks who fall short in their reserves borrow money from banks who are long in their reserves, so have excess capacity in their reserves. And the rate at which reserves are lent at the end of every business day through the interbank market, the rate at which these excess reserves are lent is actually at an interest rate. And that overnight rate is the prevailing interest rate in the market. And the way central banks set interest rates is that they actually intervene in that market. They intervene in the interbank market. And I guess the best way to do this is just go through an example. Let's look at expansionary monetary policy. So a central bank trying to stimulate an economy. That would actually involve a central bank going into the interbank market and buying short-term government bonds off the banks themselves. And that's an injection. And the idea from the central bank is that this will increase bond prices and lower short-term market interest rates. And that will basically encourage the banks to lend to each other and increase liquidity between the banks, encourage them to lend to businesses and encourage them to lend more to individuals. So increasing loans to businesses and individuals. But the way the mechanism works isn't a guy walking into the central bank and deciding today interest rates are going to be 1.25%, and then he puts them in an Excel spreadsheet in a cell, and then that email goes off to all the banks, and all the banks set their interest rates at a particular level that they're told to set them at. It's actually a mechanism by which the central bank intervenes. Now, we briefly skimmed over how QE earlier is a forthright, outright bond purchasing program. And we stated how this differs from a classic stimulus and contraction or deflationary policy from an investment bank, a central bank. This is what we're talking about here, because central banks, when they want to lower or increase the interest rate, they don't do it by sitting in front of a computer and just announcing that the interest rate is going to be at this level and all the banks follow. They actually intervene in the interbank market and they target an interest rate that they want to get to. So the contractionary way of doing this to deflate the economy typically involves the central banks selling short-term government bonds. So they're not only just buying government bonds, they're selling them as well, in order to make withdrawals from the system. And this basically raises short-term market interest rates and discourages banks and makes them decrease loans. So basically withdrawals are coming out of the system. Now, when the central bank is in the mode of lowering interest rates, this is called being dovish. They are basically buyers of short-term government bonds. And when the central bank is in the mode of increasing interest rates, they are basically what's termed hawkish, and they are sellers of short-term government bonds. So how does all of this actually affect the exchange rate of a country? That's what we're really focusing on here in the Forex markets. How does the mechanism of lowering and raising interest rates through the interbank market by a central bank actually affect the exchange rate of a country? Well, basically when interest rates are falling, all things being equal, this discourages capital from abroad flowing into a particular country for the purposes of investment in favor of countries with relatively higher interest rates. So we say a risk-free investment here, because what you're doing if you go to a country and invest money in one of the big, large financial institutions like a bank, or you're buying short-term government debt, it's a very low-risk investment, or supposed to be. And the classic finance term is that we call this a risk-free investment. And the interest rate is supposed to be what's called the risk-free rate. And in the situation when interest rates are falling relative to interest rates in the rest of the world, that discourages capital flowing into the economy. And in fact, it basically encourages money to flow out and go to find a home somewhere else in the world where capital can get a higher risk-free return. Therefore, the currency gets sold. So the exchange rate goes lower. That's all things being equal. Now, when interest rates are rising, this encourages capital from abroad flowing into the country for the purposes of getting a higher risk-free rate, a higher risk-free investment relative to the rest of the world. So money flows away from other countries into the domestic economy. And that means the currency has to be bought. So the exchange rate, all things being equal, goes higher. Now, what matters is the interest rate differential. For the exchange rate, what matters is the interest rate differential. And this forms the basis of what's termed as a carry trade, or carry. So we're going to come onto this later. Basically, this means that money flows to risk-free investments and the money gets a carry in the interest rate. Understanding carry and interest rate differentials is really crucial to understanding Forex market trading, because it forms one of the major fundamental drivers of exchange rate value. For now, what we just have to understand is that central banks that have got floating regimes primarily control inflation via the interest rate mechanism, and they increase or decrease reserves and loans, or the money supply. This is basically the actual definition of a dirty or managed float. So they can use interest rates, short-term and long-term, even through QE. They can use interest rates combined with classic money supply, or if money supply levers fail, to manipulate the exchange rate in targeting growth and inflation. So let's just understand the basics for now. whilst we're building this foundation out, there's obviously a lot of information to take in. So, if you feel like you have to go through the video series a lot of times, that's absolutely fine. That's what the video series is there for. What we're doing here is building this foundation to allow us to build out a systematic process. So when we build out the systematic process, we can start to take this knowledge and information for granted as it's known. And then we can start really delving deep into what really fundamentally drives currencies. So let's just understand the basics for now. And we can move on to governments and how governments as participants affect the exchange rate is really direct intervention in both the import and export markets.
Okay, so let's begin to try and understand how governments affect the exchange rate on the international Forex markets. They can do this in a couple of ways. One way is to introduce import taxes or tariffs. And this policy by a government is intended to be an inflationary measure. So it's supposed to make or intended to make the prices of domestic goods increase and create inflation in the domestic economy. So if a government wants to do this, they can make domestic goods relatively cheaper to the rest of the world by introducing import tariffs on foreign goods, making them more expensive for domestic consumers. Now, what happens in this mechanism when this occurs is that foreign goods and the currency of foreign exporters, as in the countries producing the imports to domestic consumers, the foreign goods and the currency are in relatively less demand, and the currency in less demand on the international Forex markets. So when a policy like this is rolled out by a government, the foreign currency tends to fall in value and the domestic currency rises in value. Historically, this is basically a protectionist policy. So to protect industries, like the car industry, for example, where countries who are big producers of autos want to protect their domestic car industry, for example, from cheap foreign imports, they may put very high import tariffs on cars produced by foreign nations. And this makes the cars much more expensive and keeps the prices of domestically produced cars at the rate that the auto industry wants to sell the cars at in order to maintain a business that has an achievable margin and profit. So that's a classic example. The reverse happens if the government decides to lower import tariffs. So the exchange rate, or get rid of tariffs altogether. So the exchange rate of foreign trade partners tends to rise due to a higher demand for imports relative to domestic goods. So if they do the opposite, it's basically a deflationary policy for domestic goods. Another way of doing this is to not target imports, but to target exports. So if the government intends to deflate, so to bring in a cooling down measure, they can make domestic goods relatively more expensive than foreign goods. They basically they can do this by increasing tariffs or taxes on exports to other countries. This makes domestic goods much more expensive for consumers abroad. And what tends to happen is the currency, the domestic currency and goods are less in demand, the currency less in demand on the international Forex markets. And it falls in value, and on the other side, foreign trading partners, their currency rises. And the policy is intended, obviously, to be deflationary. Otherwise, they wouldn't introduce it. They're trying to cool down prices in the domestic economy. Now, when you look at these two situations, if the exchange rate just adjusts in both situations, then it wipes out the tariff. So, for example, let's assume on the import example that a government puts a 20% import tariff on foreign goods, and they do that on all foreign goods right across the board. Well, the policy might not work at all, because if the exchange rates of the foreign trade partners fall by the same amount as the import tax has increased, then it just means the net effect is the goods cost the same as before. So imports will probably stay the same. Now think about this in terms of exports. If the deflationary measure of bringing an export tax on all goods produced domestically going abroad occurs, and let's say they put a 20% export tax on all goods going abroad, if the domestic exchange rate falls by the same amount as the export tax has increased, then it just negates the entire increase or the entire amount of the tariff. So basically, the semantics of this situation can mean that there's no change other to imports and exports. But what's actually happened is that the exchange rate has moved. So it's quite important to understand the mechanics behind this, because it can affect exchange rates a lot. In most developed nations, there's generally, at the moment, always duties or taxes on both imports and exports. Therefore, what's important is actually the balance or the ratio between the taxes. That's what really matters for the exchange rate. Protectionist strategies throughout history, as we've just seen, they rarely work, because the exchange rates of the currencies tend to adjust over time by the amount of the tax increases and decreases anyway, and that renders the tariff change completely meaningless. So it's really the balance between the two, and understanding this mechanism is important, because the exchange rate will actually tend to self-adjust over time. Okay, so the way in which governments overall affect the exchange rate, the main tool is obviously taxes or tariffs on importers and exporters. And in this section, looking at the infrastructure and all of the participants, it's really important to know what the agenda and the remit of all of these participants is. Once you really understand that as a retail Forex trader, when you look at the fundamental participants, so pension funds, hedge funds, businesses and corporations, and also central banks and governments, these guys really affect the fundamentals of the exchange rate. And what we've learnt in this section is if we know what the agenda is and the remit of these participants, it gives us a much greater sense of what to expect in the future in terms of exchange rate movements, or it could do. So later on, we further analyze in the systematic process what goes on behind the scenes with these players. And we start using a multitude of drivers to really understand what is driving an exchange rate and what to expect in the future from the fundamentals. So what we can actually do to recap is basically group these participants into two areas, so speculative and non-speculative. And really the non-speculative participants drive the fundamental moves in currencies. So there's a genuine economic reason or business reason behind the transaction. And what we learned was that businesses and corporations, pension funds, central banks, governments, they're the real fundamental participants of the Forex market. But they are the minority of daily global Forex market transactions. Investment banks are the participants that really process the fundamental flow or volume in the Forex markets, because they're dealing on behalf of businesses, corporations, pension funds, and also dealing with hedge funds. Now, hedge funds in our analysis are by definition speculative. Their portfolios are speculative. But they do use Forex as a hedging instrument, and they also use Forex to fundamentally hedge their portfolios, because it provides correlation to their portfolio, and therefore can be used as a tool to hedge stock portfolios, commodity portfolios, and also bond portfolios, or a mixture of those asset classes. However, they are by definition speculative, because in their overall portfolios, they are basically trying to speculate on the future move of asset prices. So there is an overlap there, but please do understand the distinction that if your portfolio is speculative by definition, if you are using fundamental drivers to make your decision, that's a different type of speculation to a retail trader Forex account with a CFD or spread betting company, and the driver is non-farm payrolls combined with a chart. It's obviously quite different. There's a lot more research put into hedge fund portfolios, and also the time frame that they position themselves over is much longer in order to capture bigger volatility. Investment banks are also pretty similar to the way hedge funds operate with their portfolios, but not on the market making side. This is when they're trading on risk and on a proprietary basis. And basically, retail traders or short-term speculative positions make up about 80% of daily transactions in the Forex market. So what we want to be as retail Forex traders, what we want to aim for is to be more like the hedge funds and the prop trading desks at investment banks. What we want to be doing is staying in business for a very long time, forever, if we can help it, be consistently profitable in Forex, and use Forex as a tool potentially for hedging overall portfolios in stocks, bonds, and commodities. But if we are going to be speculative on Forex, what we should be aiming to do, if we want to be in the minority of the 20% in daily transactions and in the minority that make money in the Forex market, we need to be using fundamental drivers and increasing our time horizon. And the reason we're looking to do this is because it's basically a different approach to speculation. So we, by definition, are speculators on asset prices and exchange rates or Forex values, but we're seeking to become the smart money, similar to hedge funds and investment bank prop trading desks. That's because we've now fully understood how the infrastructure of the retail Forex market works and the conflict of interest that exists. So we don't want to fall into the majority of the 80% of daily market transactions that's short-term speculative based on non-fundamental drivers, and also falling into the 90-90-90 situation. So what these guys are really doing is using a systematic approach and taking fundamental Forex positions to predict the future. That's what the smart money's doing. Unfortunately, the dumb money is believing everything that they're told by the participants who have a conflict of interest. So brokers and educators. And when we talk about educators, we mean the guys who promote all the short-term trading strategies because they have a conflict of interest in that they have contracts with the brokers that are volume incentivized. So they get a rebate on the commissions or spread that their introductions that they make to the brokers. They get a rebate on those commissions, and they get paid this on usually a monthly basis. They're promoting short-term trading strategies, and they're basically just brokers in disguise. So they're working essentially for the brokers because they're contracted by the brokers. So brokers and educators are generally the same thing. They're just called a different name. This structural conflict of interest just causes a situation where the brokers and the educators, they obviously want to maintain the status quo and get paid regularly. So they promote strategies where they require you to look at only short-term timeframes and teaching you how to click the button as many times as possible and doing it in the biggest size possible. Retail brokers themselves are really only transacting speculative retail business on an OTC or agency basis. They're obviously volume incentivized, size incentivized, and they take the other side of losing trades. It's pretty obvious, therefore, to maintain the status quo, they absolutely need to, they need dumb money to continue to exist. So they promote the dumb money strategies and put a lot of money into marketing to make sure the status quo is protected. And because of that, 90% of retail Forex traders, as we've seen, lose money. But what's the solution? Well, just understanding the infrastructure and how it works puts you in a very strong position, because we're not just looking at retail broker and retail trader participation here. We're looking across the spectrum. We're also looking at how professional traders at hedge funds and investment bank prop desks, how they actually behave. And we're also looking at central banks and governments, because we have to understand how these major participants work with, of course, businesses and corporations. Now, just understanding all of that infrastructure puts you in a strong position, because you make automatically the relative assessment on what the position of retail traders and retail brokers is in the Forex market. And it's pretty obvious. It's the dumb money that's 80% of daily transactions, because everything's volume incentivized, and they fall into the 90% that lose money. What has to happen as a retail trader is you have to understand how this infrastructure works, have an appreciation for it, so you realize two things. One, I have to change because my relative assessment tells me that I must change, and all the proof is there. The statistics are well known, so I have to change. And secondly, the other participants in my relative assessment, businesses, corporations, hedge funds, pension funds, investment bank prop desks, central banks, governments, they're all fundamentally driven. And that's where money flows to. Money flows away from the dumb money to the smart money via the medium of the Forex market. So what we have to do is actually build out a systematic process that helps us to predict what businesses and corporations, pension funds, central banks and governments will do in the future. and we buy and sell currencies based on our future predictions, and we move away from speculation over short timeframes, and we move towards speculation over medium to longer term timeframes based on fundamentals in the majority. And when we go through our systematic process, you're going to see that fundamentals make up 80% of the systematic process roughly, and technicals make up around 20%. So more on this later. We will go through the systematic process later, but we have to continue to build out the foundation. For now, let's go back to the trading desk and let's have a quick recap, and then we can move on to video number 4.
Okay, so welcome back to the desk. What you saw there was a full breakdown of really the biggest players in terms of the infrastructure of the Forex markets. And we obviously went into quite a lot of detail with businesses and corporations, and we started to really get our hands dirty into the detail of the behaviors of exporters and importers and how they are really affected by the foreign exchange markets. We also made a differentiation between pension funds and hedge funds, and also a major differentiation between how they approach the markets relative to retail traders. And we also made a big differentiation between the owners of the infrastructure, investment banks and retail banks, and the infrastructure that retail brokers manage for retail traders. And there's obviously a massively stark difference between pension funds, hedge funds and retail traders and where they clear their business. Now, I don't think we have to labour the point here too much. I think by now you've probably got a very good sense and understanding of how these differences work and the approach that we need to take from the lessons that we learn. Even if you just watched this video and as a retail trader went into the retail Forex market, just having an understanding of this will probably make you survive. And as long as you survive the 90-90-90, you're probably going to stand a very good chance in the future just making money. And that's part of the trick as a retail trader. And part of the trick is just surviving the first 3 months. If you get through the first 3 months, all the statistics that we see on our side basically dictate that you stand an extremely high probability chance of making money longer term. So even if you only watched this video and understood how the retail trader Forex market operates relative to the rest of the Forex market, even if you just saw this video and understand this, you're going to stand a very good chance of survival and then moving on to make money. In the rest of the video series, we're obviously going to provide you with a big systematic framework to enable this. We also looked at central banks and governments and how central banks specifically, how they use levers, monetary levers, so interest rates, money supply, and also direct intervention into the Forex markets. And we also looked at governments, which are the other side of intervention, which is fiscal levers, and specifically tariffs or taxes on exports and imports. And when you look at all these participants outside the retail Forex market, the lesson to really learn is that everything's fundamentally driven. So we obviously have to begin predicting what these participants are going to do in the future and position ourselves now based on that expectation. And the drivers that are fundamentally driving the Forex market are driven by the participants that we've looked at, so businesses and corporations, pension funds and hedge funds, central banks and governments. Retail and retail brokers are the infrastructure where low quality dumb money speculation occurs, and that's where money is transferred from the dumb money to the smart money, to the fundamental infrastructure. Okay, so we're continuing to build out this foundation and understanding of everything. Now we're going to go on to video number 4, basic computational methods, which is absolutely necessary in the Forex markets to get yourself up the curve into understanding the dynamics of the numbers behind Forex. So I'll see you at the trading desk in video number 4.
Created with free version for non-commercial use.